Growing up, I remember hearing how some people seem to know the secrets to saving on their taxes. Maybe they had better access to savvy accountants, or maybe they simply learned the ins and outs in lessons I was never exposed to. But I found out there's actually a pretty simple method for investors who want help saving on their taxes. It's called tax loss selling, and it's also known as tax loss harvesting. Stick around and we'll talk about 4 tips on how to save on your taxes. If you've invested in a non-registered account, you can actually use your realized losses from your bad investment to offset some or all of your capital gains, which can result in you paying less tax. For example, let's say you bought $100,000 worth of shares in a stock in a non-registered account, and you sell the shares at a gain of $20,000. Since 50% of the capital gain is taxable, that means $10,000 would be counted as taxable income and taxed at your marginal tax rate based on your tax bracket. Now, let's say in that same tax year, you sold shares of another stock, but at a loss of $20,000. You could use 50% of the $20,000 capital loss to offset the $10,000 taxable capital gain from your other investment, meaning you'd have no taxable capital gain subject to taxes. Cool, huh? Here are 4 simple tips for you to remember. But first, like and subscribe if you like more investing videos like this. Tip number 1 is knowing how to calculate your capital gain or your capital loss. To do this, you first need to determine the total cost of the investment you made. That includes commission, reinvested dividends, or legal fees. This is called your investment's adjusted cost base, or ACB for short. Then you subtract the ACB from how much you sold it for, minus any selling costs, and the remainder is your capital loss or capital gain. The formula you could use looks like this. Tip number 2 is that you can apply net capital losses as far back as 3 previous tax years, or you can carry them forward indefinitely to future tax years. A net capital loss is any allowable capital loss that you have remaining after offsetting a capital gain in the tax year it occurred. If you decide to apply it to previous years, you could receive a tax refund or a reduction in taxes previously paid. Tip number 3 is to watch out for the superficial loss rule. This means that you can't claim a capital loss on the sale of an investment if you or someone affiliated with you, such as a spouse or a corporation that you or your spouse owns, for example, buy the same investment or something identical to it within 30 days before or after the sale. Again, that's 30 days before and after the sale. And finally, tip number 4. Remember that when you sell an investment such as stocks and bonds, the settlement date occurs 1 business day after the sale. So for it to count for that tax year, the trade must be settled by December 31st. And don't forget holidays. For example, if you sold an asset on a Friday, then it wouldn't be settled until the following Monday if that Monday is not a holiday. And there you have it. 4 tips to help you save on your taxes by using your most disappointing investments to your advantage.
Vous avez d'autres questions? Cliquez sur les liens à droite et dans la description ci-dessous.